The 7 important gold signals to watch now. Is it too good to be true for gold, or is this it? Under the leadership of Kim Jong-un's sister, North Korea just blew up a South Korean liaison office. Talk about making a debut. There are growing tensions between India and China, which led to at least 20 deaths. An increase in coronavirus cases is erupting in many countries and U.S. states. Florida and Nevada are seeing daily cases rise. If civil unrest is measured like the VIX volatility index is in stocks, we'd be at all-time highs. And we haven't even started getting into threats of draining the swamp, a ramp up in election coverage, or mail-in bailout controversies. The stock market does not seem to care. Gold is consolidating and looking to make a breakout. To recap where we're at: unlimited stimulus by governments and central banks around the world, deteriorating government relationships between superpowers, a pandemic that has killed over 448,000 people with over 8 million cases. Now let's rewind for a second. In a surprise move on Sunday, March 15th, the U.S. Federal Reserve announced its first monetary stimulus package. Considering the planned meeting was for the Tuesday, the world took it that things must be really bad if the Fed must announce its plans 2 days early. Unsurprisingly, the market went limit down overnight on Sunday and cratered after the open. But by noon, momentum had switched and, buy the dip, trade was on in full force. While not a goal of the U.S. Federal Reserve, the shockwave sent through the market was significant. It has fueled the fastest and most significant rally seen after any major economic correction. What you're looking at right now is the Dow Jones post-crash bounces from 1929 and 1987, 2008, and 2020. The blue line is what you should be looking at, and look at the fastest correction. In normal times, these kinds of geopolitical developments can roil global markets. And the fact that the market's reaction has been muted is worrying. Investors can only account for so much risk and uncertainty. Regardless of who wins, this election will be unlike any other in post-World War II history. A heavy reliance on mail-in bailouts, court challenges, and recounts could result in an uncertainty not seen since the 2000 presidential election. One thing that has happened historically is that when the stock market goes up, gold prices go down and vice versa. This may be seen as a silver lining for those gold bugs who fear that a Biden presidency with someone like Elizabeth Warren as VP would be decidedly less business friendly. So how does gold perform in election years? The usual answer is not very good, except for 2008, the last time there was chaos. In the 2008 election cycle, the election of Barack Obama was tepidly received by the stock market, which was already reeling from a financial crisis, while gold prices surged 28%. What you're looking at now is the returns during election cycles from November to January, going back to Ronald Reagan's first election. Gold continues to outperform in 2020. Lately, many investors have been trying to trade the intraday chaos in the NASDAQ and bankrupt names. Picking up pennies in front of a steamroller only works so long. In the long run, a focused mindset is critical to achieving investment success. On a year-to-date basis, gold is leading the pack across major asset classes. What you're looking at right now is a chart of the year-to-date returns of the major asset classes, such as gold, the NASDAQ, the US dollar, S&P 500, and the emerging markets, which has done quite awful thus far this year. Gold has been one of the best performers year to date. Yes, I'm also aware that Bitcoin is up about 30% year to date for all my fans who are Bitcoin people. While physical gold and gold stocks have exploded higher, gold-focused producers are actually still cheap, if you know where to look. The best multiple for demonstrating this is a price to cash flow multiple. I use a cash flow rather than earnings because it's much harder for a company to goose the system with fake earnings. Cash flow from operations does not lie. Shown below is a comparison of price to cash flow multiples between the different sectors. So what you're looking at right now is the price to forward cash flows per share of the gold producers from the mid-tiers and juniors to its peer group in the Russell 2000 and the S&P 500. As you can see, even if gold producers catch up to their peers in the Russell 2000, A major lift in mining equity prices is to come. In simple language, the share prices are going to go higher. Now, I don't base my investments and speculations on technical analysis, but I know that many traders do. So let's factor it in. Gold has made a major move from the $1,400 per ounce area to just above $1,700 per ounce currently. Our subscribers to the KRO have had an incredible year to date of gains as a result of our gold mining stocks portfolio. Gold needs to build a strong support level around $1,700 per ounce, and it's on its way in doing so. I do believe a breakout will come, but more time consolidating at the $1,700 level is healthy. I see two scenarios for gold in the near term. Scenario 1, gold bounces around the $1,650 to $1,750 per ounce range over the next 12 to 16 weeks and consolidates a base for the next leg higher in the spot price post-election. Scenario 2, the gold price drops over the next 12 to 16 weeks. Now, if gold corrects, I am prepared with my shopping list of companies to purchase my next tranches in the best of the best peer group of the gold producers. I want to be prepared for the next leg of the gold bull market also. Now let's put the scenarios in visual form for some clarity. Here are my short-term support and resistance levels for gold price. What you're looking at right now is actually just the spot price of gold, and that horizontal bar is actually its base price. Now, the major resistance point, which is now support at that $1,350 to $1,375 per ounce, is gold. So the longer the base support of the resistance at that 1,700 price builds, the healthier it is. Now, it could correct, I don't know, but it's important to keep a bigger perspective of what could happen. How does gold perform seasonally? What you're looking at right now is the monthly returns for gold since 1970. This is called a seasonal chart. 50 years of data suggests that this summer will most likely be boring for gold using historical averages. The average return for gold in June, July, and August is 0%, 0.6%, and 0.9% respectively over the last 50 years using monthly averages. So you can see that though April is the strongest month, and the summer is kind of, let's just say the gold bugs are on holiday. But we know that this year is anything but normal. Coronavirus and Donald Trump are two huge wild cards that will keep everyone glued to their desks this summer. And you'll notice that gold has had much wilder swings in 2020 than in years past, hence why this summer may not be boring as history suggests. A move up or down $100 is not out of the question. Does gold go mainstream? Gold holdings in ETFs are at record highs in terms of tonnage and assets under management, which in the business is called AUM. Even the institutional shorts are starting to cover their gold shorts, with the most recent 100,000 contracts being covered. If you look at since April 2019, ETFs have increased their gold holdings by 42%, or 33.5 million ounces. That's what this chart is showing, the gold ETF holding as an indicator of gold prices. You can see that it's increased to 42% since April 2019. You'll notice that during the big run in gold prices from 2008 to 2011, as gold increased 105%, ETF holdings increased 84%. A 14% rally in gold prices in 2016 led to a 35% increase in ETFs holdings. So far in this run, gold is up 20% and the ETF holdings are up slightly over 40%. Owning some physical gold is a good hedge investment, but if you're looking for big return, you have to look into the gold equities. That's the actual gold mining shares. These stocks are highly leveraged to changes in the gold price. Below is a chart which compares the Katusa Resource Opportunity Gold Stock Portfolio to the mainstream ETFs and indices. Now what you're looking at in the green line is our portfolio, and in the blue line is the Junior Gold Miner ETF known as the GDXJ. There's yellow is the physical gold, the black line is the NASDAQ, and the red line is S&P 500. As you can see, year to date, we have outperformed every other index. I've spent 2 decades in the business building relationships with some of the smartest and most successful resource titans. You cannot replicate this type of intellectual capital. Even though a recent recommendation, which was a buy in the open market recently, is up 250% in the past few months, I'm not slowing down. Right now, I'm working on a new investment idea. I'm actually filling out all the government required paperwork to finally get to the airport and on my next site visit, and hopefully my next big recommendation. If you're interested in learning more about the KRO portfolio and the next sector I will be rotating these big profits into, please follow me for the Katusa resource opportunities.